Hi everyone, welcome to this session. The main objective of this session is to discuss the central banking and the role of central banks in the money supply process. So, more specifically in this session we will cover what are the functions of central bank, especially the process through which central bank influence the money supply in an economy. So, that is the main objective in this session, and this discussion we will continue in the subsequent sessions as well, where we get more into the process of determining money supply in an economy. So, coming to central banks play a crucial role in ensuring economic and financial stability. So, they conduct monetary policy to achieve low and stable inflation, and overall the central banks across the globe are considered as the monetary authority, and they are tasked to act as the apex banks, that the bankers bank, and also to act as the lender of the last resort. So, overall the role of central bank is to ensure economic and financial stability in an economy. So, coming to this, the first thing, the important function of role is to influence the money supply in an economy to ensure monetary stability in an economy, so that it also positively affect the economic growth as well. So, coming to money, by this time you are already familiar with the concept of money. So, let us just have a quick overview of what is money. So, money, according to Adam Smith, he used money in synonymous with wealth, that in common language considered as in every respect synonymous to, that means money means income or wealth according to the very old conventional definition. But this is not at all what modern monetary economists mean by money. In modern economies, as in Adam Smith, wealth is produced in the real economy through the production and exchange of goods and services. And money has, when we talk of money, we are discussing one part of wealth. So, that means if you recall our discussion in the previous sessions, money is one of the asset, one of the alternative asset that we have seen. So, in that way we can say that money is a part of wealth, but not all wealth does not mean that is money, right. For importantly, money is one part of asset or one part of wealth. Functions of money, overall money, the main functions of money is one is to act as a medium of exchange or payment, that means in facilitating the act of exchange, that is one. Second one is money to act as a store of value, to store the value or wealth of someone or individuals or institutions. Then the third one is to act as the unit of account and a standard of deferred payments, that means in expressing in a common unit the value of the many different goods and services produced is a unit of account as well. Money thus is the most liquid part of wealth, that means that part which can be most readily exchanged for goods and services. So, this also we have seen in the previous sessions, that means we discuss money as one of the most liquid. So, among all the assets, we said that the most liquid asset is money, that means money, the demand for money. In that respect, we said that demand for money is also called as demand for liquidity preference. That means the liquidity preference means actually people are holding more money. So, money in monetary economics does not mean income or wealth, that is the main takeaway from here. Rather, money is any asset acceptable in exchange for goods and services. Thus, money is a subset of all those assets that might be acceptable in exchange. So, coming to the money supply, so this is the concept that we often use. So, the money supply means the total quantity of money available to the people, that the general public in an economy. And though we use, to our understanding, normally we use supply as a flow variable, but when it comes to money supply is actually, it should be better to call money stock also, is actually money stock is a stock variable. That means the total quantity of money at any particular point of time. So, when we talk about money supply, actually we mean total quantity of money at any particular point of time in fact. And the money supply is measured, the quantity of money in an economy, as the sum of those items that serve as a medium of payments in the economy. That means command over the purchasing power. So, any item that you see that you can easily use it as a medium of exchange, or that means you use it as a for your purchase, then that means that is we can call it as money supply. There are various definitions for money supply definition. The first one we call monetary base. We will explain it in detail. Monetary base means mainly we also call it as high powered money. After a couple of minutes we will give a proper definition of monetary base, what constitute monetary base. By using appropriate relevant variable we will define it. But for short, monetary base is the high powered money based on which the central bank can create, further generate or multiply the money supply. Then coming to first definition called M1 money supply. M1 money supply is called the narrow definition of money. So, narrow definition of money here means currency held by a public, and the public's, that is one component C, plus the public's checkable deposits in financial institution, that is mainly with the commercial banks. So, checkable deposit means we can also call it as demand deposits. That means the money that you can withdraw at any time. Here why we call it, because currency means the currency in circulation, currency with you, that means you can use it for as a medium of payment at any time. Then how demand deposit, the money with the public, money with the banking system by the public, that is demand deposit, which can be withdrawn at any time, right. That is the one of the feature of checkable deposit, that the money can withdraw at any time, whenever you want you can withdraw at any time, in the 24 hours, right. So, that means there is no restriction at all. So, then because it can be withdrawn at any time, that means your money with the bank, that is demand deposit, it is almost equivalent to currency. That means you can spend it at any time, right. You can spend it at any time. So, because of that, the M1 definition, the narrow definition, they say that the checkable deposit also should be part of money supply. That means money supply means C plus demand deposits, because both are highly liquid and can be used for purchase of goods and services at any time. Then comes to the second definition, that is called M2 definition. M2 definition means more broad definition of money. This is given by Milton Friedman. The sum of currency in the hands of the public plus, that means C plus, here C plus all the public's deposits in commercial banks. It not only include demand deposit, which we mentioned here, but also include savings deposit in commercial banks, because saving deposit these days due to the development of the banking system, banks made it in a way that actually you can even withdraw the savings deposit also at any time. Unlike similar to current deposit, a checkable deposit, savings deposit also can be withdrawn at any time. So, because of that, this also almost is highly liquid, so that is also become part of money supply. So, this is M2 definition. So, a still broader definition of money than Friedman definition is M2 plus deposits in near banks. That means even banks and even non-banking financial institution also include. That means those financial institutions in which the deposit perform almost the same role for the depositors as similar deposits in commercial banks. So, examples of such institutions are Savings and Loan Association and Mutual Savings Bank in the United States, and credit union, trust companies and mortgage loan companies in Canada, and building societies in the UK. So, Accordingly, there are several further definition that may actually little bit addition with the M1 and M2 definition, that is M2, M3, M4 like that. However, the definition of the symbols have not become standardized and remain country specific. Let me now show you the money supply definition that is being used in the USA. They have M1, M2 and M3 definition, and starting with the M0, that is the monetary base. So, the concept of money supply in the USA, we can see that this one M0, M1, M2 and M3. So, as per the federal definition, the definition given by Federal Reserve System, that the US central banking system is like that. That is, M0 means the total of all physical currency plus accounts at the central bank that can be exchanged for physical currency, that is the monetary base or high powered money. Then comes M1. M1 means the monetary base plus amount in demand account, that is checking or current accounts, that the money can be withdrawn at any time whenever the depositor wishes, right. And then comes the M2 money supply definition. M2 means M1 plus most savings bank accounts, money market accounts and small denomination time deposits and certificates of deposits accounts. So, coming to M2 here, one of the things you might have observed, that is the time deposit. So, the time deposits means there is an expiry date, a maturity date, maybe for 1 year, 5 years or 10 years, mostly it is for 1 year or 2 years. Though is called as time deposit, but over the time what you can see that because of the development of the banking system allow even the time depositors, who deposited money for a fixed period of time, they can also withdraw the money withdraw their deposit at any time, but at a penal rate of interest. They have to compromise or sacrifice some of the agreed rate of interest, but that means at a reduced rate of interest they can withdraw their fund. So, that means even time deposit also having a characteristics of that means it can also be withdrawn at any time. So, that means the money that you are keeping in your bank as a time deposit, that also serve as money, that means you can withdraw at any time. So, because of that also become part of money supply, that means the M2 money definition, right. Then comes M3 money definition. This is a very broad definition, that means M2 plus all other deposit accounts, deposit in euro, dollars, that in foreign banks and repurchase agreements, everything become part of money supply. So, that is M3, that is very broad definition of money. And for Canada, the money definition is given like that is M1 money, that is currency in the hands of public and demand deposit in chartered banks, and then M1 plus, and then M2 money, then M2 plus, then M3 money. So, you can see that M1 then M1 plus somehow, that is personal checkable deposit, non-personal checkable notice deposit at the chartered banks, mortgage loan companies, etc., credit unions, etc. So, there also in broadly they have M1, M2 and M3 definitions. Then coming to India, the definition given by Reserve Bank of India is like this, that means reserve money means currency in circulation plus bankers deposit with the RBI and other deposit with the RBI. So, here this is the expanded form of this one, that is the reserve money. Then coming to M1 money means currency with the general public, and demand deposit with the banking system and other deposits with the RBI. Then coming to M2 means M1 plus savings deposits of post office savings bank, that is M2 definition, and M3 definition, this is widely used in India, that is M1 plus this plus M1 plus time deposit with the banking system. That means currency in circulation plus demand deposits plus other deposit with the RBI plus then the time deposit as well, then including the time deposit that means with a fixed period of time. Time deposit means here fixed deposits and recurring savings deposit account. That means fixed deposit means for a certain period of time, that deposited for a period of time, 1 year, 2 years, like that. And recurring bank deposit means that also time similar to time deposit, but actually a fixed amount is deposited in the bank on a regular period of time. Right, a fixed recurring savings deposit account, a savings made by people on a deposited money deposited in a bank at a regular period of time. Then comes the M4 money definition, that means M3 plus all deposits with the post office savings bank excluding national savings deposit certificates. So, these are all the broad definitions of money across the country, and as I mentioned before, the definition of the money supply definition is country specific, but overall we can see that there is a broad agreement with this money definition. Everyone agree with that. M0 is the monetary base, then M1 and then the M3, that means currency in circulation plus all kinds of deposit including demand deposit and time deposits. So, that actually a general agreement among countries. So, let us now see why money supply is important. We have already seen what is the money supply definition and why money supply is important. Importantly, you know that movements in money supply affect interest rates and overall health of the economy. So, when the economies are becoming more and more monetized, then you know that money supply plays very crucial role in an economy, and it has impact on interest rate and as well as inflation as well. It also has impact on inflation. It also has influence on, later on we will see that in exchange rate, forex rate, it has influence on forex rate, and we will also see that money is going to affect the GDP, that means the overall level of economic activity, that means the production of goods and services, GDP and employment, etc. So, that means it also affects overall health of the economy, and the movement of money supply also has impact on the stability in the system, that means stability in interest rate, stability in inflation, stability in forex rate, and it has impact on the stability in an economy of certain key economic variables. And because of all these reasons and many other factors that we are going to discuss in the coming session, we are going to see that money supply is a very important variable. And already we said that the central bank of a country is the monetary authority and who actually has more say on more control over determining the money supply. So, with these backdrops, let us see how is the money supply determined and who controls the money supply and what causes it to change. This is what we are going to discuss in the next couple of minutes and in the subsequent sessions. So, in the money supply process, there are mainly 4 players. The first one is the central bank, and as we already seen that central bank is a monetary authority that oversees the banking system and responsible for the conduct of monetary policy. And the second key player is the banking system itself, that the banks and especially commercial banks, savings and loan associations, mutual savings banks and credit unions. That is another key player. And then comes depositors. The depositors means individual institutions that hold deposits in banks. And in addition to that, the borrowers from the banks, they also become a key player in the money supply process. That means borrowers means individuals and institutions that borrow from the depository institutions and institutions that issue bonds that are purchased by depository institutions. These are the 4 key players, and what we are going to do now, we now focus on the central bank, who is the key player in this process. Then how central bank through the central bank activity, that is through influencing through the balance sheet, its liability and asset side, we are going to see that how central banks conduct of monetary policy, how it affects money supply. And the central bank, when they conduct monetary policy, it involves actions that affects its balance sheet, that means holding of assets and liabilities. So, we are now going to discuss how the change the conducting of monetary policy by the central bank, by a central bank, how does it influence, how does it affect the balance sheet, that the asset side and the liability side, and using a T account we are going to discuss that. So, coming to Fed's balance sheet, Fed means here I mean the central bank. The Fed which I mentioned here is the Federal Reserve System, that the US central banking system. So, that means the Fed, and Indian context obviously we can use Reserve Bank of India just for the sake of simplicity and international standardization of our learning materials. Let us call it as Fed. Fed means the central bank. So, in the using that Fed's balance sheet, let us now discuss the assets and liabilities. So, coming to the asset side of the central bank of the Fed, one of the asset is the government securities held by the central bank. So, Fed provides reserves to the banking system by purchasing securities. That means purchasing, buying and selling of government securities from the banking system is also called as open market operations. So, this is the process. So, that means in this process the asset that the central bank is having is the government securities. So, an increase in government securities held by Fed leads to an increase in money supply, that we are going to see in the subsequent sessions clearly. So, before going to that, let me make it clear this part, that means one of the asset is held by the Fed is the government securities, that is purchased from the commercial banks. Obviously, you know that securities with the banking system, actually they bought it from the treasury, that means from the federal government, right. So, that means whatever is that the securities purchased by the banking system, when it is purchased by the Fed, then it becomes the asset of the Federal Reserve System. So, this is also called as open market operation, which I just mentioned. You know that this one become when central bank, the Fed, sell government securities to the banking system. So, at that time it credits in the commercial banks, the banking system's account in the form of reserve, it credits. Suppose if the Fed buy, for example 10 million of government securities from the banking system, then as a proceeds of this transaction, when they sell these 10 million securities to the banking system, so the proceeds of currency, that the 10 million, this one will be credited to the account of the banking system, and it will be credited and it will be immediately reflected as the reserve, increase in the reserve of the banking system. So, this is also a kind of, we are also going to call it as a non-borrowed reserve, because the increase in this reserve of the banking system happening through the open market operation is not through borrowing from the central bank, but because of selling of securities to the central bank, right. So, as a result you can see that they will be getting 10 million with the central bank, and it will be immediately credited to the banking system as reserve. So, here which I think I mentioned, it is selling, actually it is purchasing of securities. When they purchase, then the net proceeds will be credited to the banking system as reserve by purchasing of security by the Fed. And the second component is discount loans. Discount loans means Fed can provide reserve to the banking system by making discount loans to banks, right. So, here an increase in discount loans can also be a source of increase in the money supply. So, the discount rate, discount loan means discount loans are given at a discount rate, and in India we call it bank rate. So, here what happened, that when the central bank Fed give loans to the banking system at a discount rate, that means the reserve of the banking system increases. We are going to see that the reserve of the banking system increases, and but the reserve of the banking system increases, and we are going to call it as borrowed reserve, because borrowed reserve means banking banking system borrowed it from the central bank, right. So, we can see that there are two main assets for a central bank. One is government securities that is holding. Second one is the discount loans made to the banking system. So, we are going to say that we are already just now we already discussed that government securities, this one, when they are purchasing it from commercial bank, it is done through the open market operation. This is also called as non-borrowed reserve. And the second one, the discount loans, we can see that this is the loans made by the central bank to the banking system. So, it is given at a discount rate, and for the banking system, this increase in this reserve is due to the borrowing from the central bank. So, we are going to call it as borrowed reserve. So, these are the two major assets of the central bank. And in the next session, we are going to discuss the liability side of the balance sheet. Thank you.